Good evening, everybody, and welcome to our first webinar of the year on the move with Adrian Day of Adrian Day Asset Management. I think you all know Adrian, my co-host. He's an amazing guy. He's a graduate of the London School of Economics. He's spoken on every portal you can think of, from print to media to et cetera. He's written two fantastic books on investing in resources and international investments. And he is a fantastic asset manager that I've had the privilege of knowing for better part of 20, 30 years now. So with that, Adrian, Happy New Year and welcome to On the Move 2026.
Well, thank you, Rich, and Happy New Year to you, and Happy New Year to all of the audiences, all of the people attending. How long do we keep saying Happy New Year?
I don't know until it gets old.
So thank you, Rich. Most of you will know Rich. He's the COO and President and COO of Asset Strategies International, which is primarily a coin dealer with many different programs in the precious metals, including the Perth Mint. I've known Rich for 30 years. I've known or more, and I've known his uncle, who founded the firm, one of the founders of the firm, gosh, since the early 80s. So the relationship has been a long one and a deep one, and Rich and his firm are people that I truly respect, because above all else, they put the client first, and that's really what this is all about. Well, we're very happy today to have as our guest Peter Boockvar. Many of you will know Peter, and for those of you who don't, I think you're in for a real treat. Peter's a graduate of George Washington University. He's the Chief Investment Officer of One Point BFG Wealth Partners, which used to be called Beakley, which was a little easier, Peter. And at one point, he's a chief investment officer. He leads the development and oversight of the investment strategies and also the asset allocation strategies, which which we'll get into in the discussion tonight. I won't go on about who Peter is. If there's anything in your background that you think is relevant as we're going through Peter, please by all means mention it. But I wanted to kick tonight off, if I may. Well, but sorry, before we get to that, let me just say, I was just reading from the bio here, but let me just say that 10 years ago, I had never heard of Peter, and someone said to me, "Oh, there's this great speaker. You should listen to him and try to meet him." I don't know if you remember, Peter, but I sent you a text saying, "Hey, I'm going to be at this conference. Can we meet?" And I just have to tell people, but when I heard Peter speak, I realized that he is someone with incredible knowledge, breadth of knowledge, depth of knowledge, as well as integrity, of course, which is important. I won't say the best speech at New Orleans this year because there were some really good speeches, but without question, one of the top speeches at New Orleans this year, Peter. So thank you for coming on. We're honored. So my first question really is just a very broad one to get things going. It'll probably answer some of the questions, but it'll probably raise even more. And that is, obviously, we're living in interesting times. How are you viewing the world, particularly economics and investing? How are you viewing the world today, and how are you seeing things likely to develop in the coming year or two?
Well, thank you, Adrian, for the kind words. Thank you, Richard, also for having me. Adrian, I've been a fan as well, and do my best to follow everything that you have to say, and always enjoyed our hangouts in New Orleans. So let's go through my thoughts on the markets and the economy. First, on the economy, and we'll dig into the U.S. and then we'll go global. The U.S. economy is highly unusual in that the growth is being driven by a few pieces, a few cylinders, call it, not all cylinders, whereas some other cylinders are actually dragging. Stating the obvious, the data center construction has obviously been a main contributor to economic growth. I've seen estimates from half to three-quarters of GDP growth year to date is touching that in some way, whether that is the steel producers, the cement layers, the HVAC systems, obviously the NVIDIA chips and the Dell servers, and so on and so on. Whereas the other parts of the economy that have been strong have been upper income spending, as we know. I know people like to use the letter K in describing the consumer with upper income and lower income, but I'll throw out another letter, that being a lowercase I, with the upper income spenders being the dot and everyone else being the rest of the I, because that is really, I think, a better way of sort of symbolizing the extent at which upper income spending is driving overall consumer spending. And then, of course, anything touching government spending. When you have a budget deficit of, call it $1.8 trillion dollars, that every dollar that gets spent by the government is finding its way into the private sector. A lot of that money is spent on defense, healthcare via Medicare, Medicaid, and also the interest expense of the government is somebody else's interest income. About 30% of that interest income is going overseas via foreign holders, but 70% of that interest income is either individuals, businesses, and other institutions. So when you have a budget deficit that large, it is a big footprint in terms of money flowing into the US economy. Then on the flip side, the challenges remain in manufacturing. The recession there is now going on 3 years. It was going on about 2 years, and then tariffs came about, and that has prolonged the recession in manufacturing. Just as in 2018, that tariff slash trade war put manufacturing into recession that was followed by Fed rate cuts in 2019. Housing, which is trying to show some signs of life with the average 30-year mortgage rate dropping to 6%, but the pace of existing home sales is still hovering around 30-year lows. And understand that when a house gets transacted from a seller to a buyer, and then that seller is likely buying something else, things happen to the house. You repaint the walls, you change the carpet, you put in new flooring, you renovate the bathrooms, you put in new sheetrock, you build this, you do whatever, you redo the backyard. A lot of stuff that happens with the transaction is not happening when the pace of those transactions are at 30-year lows. Lower to middle income spenders, uh, uh, in contrast to the upper income spender, they're more stressed. They're dealing with a cumulative rise in inflation of, call it, 25% since 2021, with wages at best keeping up and for some not keeping up. Particularly the cost of shelter being one's largest expense typically. Rents, even though they're moderating recently, they're up dramatically over the last couple of years, and that's been a particular pain point. So and you're seeing that in a variety of different spending habits, and I can dig in deeper with that. With respect to global trade, it's well, since the tariffs have come on, it's been very sort of a multipolar trade world that's going on, and no one defines that better than China. China, on the day we are taping this, came out with their trade data, where for 2025 their trade surplus was a whopping $1.2 trillion dollars. So call it averaging 100 billion a month. Well, interestingly, because of the tariffs, China exports to the US fell 20%. They were up about 25% to Africa. They were up about mid-teens to Southeast Asia. They were up about 8 to 9% to the EU and higher by about 7% to Latin America. So when we discuss and talk about global trade, it's becomes sort of a more bifurcated situation. And then finally, with the labor market, when in this discussion about the economy, it's clear that the pace of hiring has slowed, while the pace of firings, as seen in initial jobs claims, still remains relatively muted. And the slowdown in hiring, I know some will say, well, that's immigration. Well, maybe, but if you look at small and medium-sized business hiring since April, when the tariff war started in earnest, that hiring has slowed down dramatically and actually has turned to firings. Because small businesses, whether you agree with tariffs or not, small businesses are just less equipped to manage it. They're less equipped to manage a very sharp rise in costs. They can't quickly switch around their supply chains. They don't have the ability to quickly pass on prices to the rest of us, and they try to cut costs in other ways. And I think one of the ways they've done that is to actually reduce their labor force. So now tying this into the stock market. No, actually, wait. Let me back up for a second because I want to get global. The European economy is also mixed too. You have Germany and France, which is not really seeing any growth. We know that Germany in particular dealing with high energy costs. They stupidly shut off their nuclear facilities not too soon before Russia decided to invade Ukraine, and that disrupted flows. So you have the price of natural gas in Europe well above where it is in the US. Whereas on the other hand, you have Spain and Greece actually seeing some pretty good growth in Europe. Italy's actually, for their country, seeing some decent growth as well. You go to Asia. China's interesting. Their consumer consumption pace is relatively muted because of the impact of the downturn in their residential real estate market, which from a effect perspective has been a big drag. But then on the other hand, China is doing this incredible job of climbing the value chain ladder in a variety of different areas of manufacturing, EVs, batteries, solar, industrial automation, certainly in the technology stack to the point where they're saying to the US semiconductor companies, we may not even need your stuff. Yeah, maybe you have faster chips and you have more advanced stuff, but we can come close to replicating that, and you don't need to do us any favors here. So there's no doubt that in 2018, when the U.S. government almost took down Huawei and ZTE, that was a big moment for the Chinese economy and President Xi and their desire to become pretty much a fully independently produced country of all the things that they need in all the important stuff. And we're seeing that in their advancements, and we're seeing that also in the stuff that they are trading in. And then you go to Southeast and well, Japan. Japan's always got a slower growth economy because of their demographics, but Japan's still doing okay, particularly their stock market that's done really well. And then you look at Southeast Asia, you have Singapore doing well, Vietnam doing well, Malaysia doing well, Philippines doing well, but then you have some softness in Thailand and Indonesia. So overall, pretty much a mixed bag of things. And then in the stock market, I think we're reaching a pretty well, actually, coming into 2025 was a pretty interesting year because coming into the year last year, just to give some perspective on how I see things unfolding here, is the dominance of the U.S. stock market was really unprecedented in the post-World War II timeframe when you call it from 2010 to 2024. And with the last couple of years, of course, being dominated by the big cap tech stocks that we all know about. The interesting thing, though, about 2025 is the pendulum started to swing in the other direction. And I think one of the factors and catalyst for that was the late January news from the Chinese company DeepSeek. And there was this panic with US technology companies that, oh, wow, the Chinese can play this game too. They can do it really efficiently, and they can possibly do it at a much cheaper price than we're trying to implement it here. So we saw tremendous outperformance in international stock markets relative to the US after many years of underperformance. And particularly in dollar terms, because the US dollar had a poor year last year, with the first half being the weakest since the early 1970s. So that also helped to enhance US dollar-based investors investing internationally. Flip that, international investors investing in the US, they didn't make much money at all last year. And then fast forward through 2025, and after that AI trade got hit, it did get a second wind. But that second wind, I'm feeling that some alarm bells are beginning to sound. I think the first bell that rang was in September when Oracle announced their August quarter. The stock spiked up I think Larry Ellison made $100 billion in one day when Oracle announced a half a trillion dollars of these remaining performance obligations, which is basically the expected revenue they were going to get to bring in via the build out of the centers that they were building. But then all of a sudden, it came out that OpenAI was 60% of those obligations. So then people said, well, those are a lot of obligations. Not only is OpenAI committing to Oracle, but they're committing it to a lot of other businesses, and that the tech tentacles of OpenAI is rather wide for a company doing maybe 20 billion of revenue and committing more than themselves to more than $1 trillion of obligations over the next 8 years. Then, in no particular order, you had uh, CoreWeave, which has gotten cut in half as people start to question their business model. NVIDIA had a phenomenal quarter that they reported not too long ago. I think it was in November. Stock traded up a lot after market and then has gone and straight down since. It's now sort of chopping around because people said, well, okay, how much longer can you maintain 75% gross margins? And now the competition is really heating up because soon after we heard Google talking about their TPU business, which is now a fierce competitor against NVIDIA chips. Then Amazon has the Trainium chip. AMD is a big competitor. Broadcom's a big competitor. The Chinese are a big competitor. So I think we're all getting reminded that yeah, technology business is really competitive, and you're only as good as your last product, essentially. Then you had Meta, which reported again. This is in no particular order in terms of sequencing, but Meta reported a great third quarter. But stock has gone straight down because people started to scrutinize the huge level of capital spending. And just to quantify the level of capital spending for some of these hyperscalers, Meta is spending about 35% of their revenue on CapEx. It was low teens back in 2021 before this AI buildup began. Oracle, which raised their CapEx number in their last quarter from 35 billion to 50 billion, that is 75% of their revenue, not of their cash flow, but of their revenue. So these are extraordinary numbers, and that is altering the beauty of their businesses, where they were these incredibly efficient, asset light, hugely cash generative businesses, and now they are hugely capital intensive, and that is going to really reduce their free cash flow in the years to come, both in terms of the spending and also the elevated level of depreciation expense that they're embedding in their business. And the other company that I forgot to mention is Broadcom, also reported a good quarter, and that stock has traded off. Also, and to button this up, what we saw with the Gemini 3 model from Google exceeding the capabilities of OpenAI, all of a sudden people said, hey, not everyone can win. Because that's the history of investing in a new thing, whether it's the railroads back in the day or the internet in the late 90s, is when something hot comes along, everybody wants to invest in anything that touches it. Doesn't matter if you're making money, losing money, if you're a small company, big company. If you are touching that industry, people want to own stocks. But at some point, you reach a point where a bell rings and says, you know what? Not everyone can be successful here. Not everyone is going to win. There are going to be plenty of losers, and I think we've reached that point in this trade. So I think investors need to be cognizant of that as we look to the rest of the year. And if the trade begins to falter further because of its dominance within the S&P, making up north of 35% of the S&P, if there is any slowdown in the rate of change of these data centers being built, because they're going to be built for the next couple of years, but if there's a rate of change slowdown, these are the things that investors really need to be paying attention to this year because of the both economic impact, the stock market impact, and if the stock market gets hurt by a decline in the AI trade, that then spills over into an impact on upper income spending, which has been benefiting from the wealth effect. If that were to all occur, the question then is, at least in the stock market, is can we pass the baton on to other things? Can what we saw in 2025 be repeated? Can the investors look to, okay, I'll sell my Nvidia, I'll sell my Google, I'll sell my Broadcom, but I'm going to buy XYZ in Europe or Asia or even in the US? Because if that happens, well, maybe you can have sort of a transition. Can capital spending, which XAI capital spending has basically been flatlining over the past 4 years, and in real terms, it's been down. So the AI data center build out hasn't expanded the CapEx pie. It's only taken slices from other parts of the existing pie. But if that business slows down, that construction slows down, can the tax benefits of the big, beautiful bill that has offered the opportunity for businesses to immediately expense their CapEx, well, maybe that can take the baton. These are the things that the investors really should be thinking about when we look to this year, because very much so, the US economy, the US stock market has put a lot of chips on that poker table with respect to both the build out and the stock market performance.
Was that a deliberate pun to say chips?
I was going to say the same thing.
So I hope I laid out, a good sense of both the economy and the markets and how I'm viewing things for this year.
Well, that was an absolute masterclass. And honestly, I've got about 200 questions. I don't know where to start, but can we, and then Rich, obviously, but just one
And Adrian, I didn't even talk about the Fed. We're almost a half hour in and we didn't talk about the Fed yet.
We're going to get there, I'm pretty
And
sure.
rates.
But you mentioned, I think one of the most important things for the listeners is when you talked about rotation, and how foreign markets obviously did better last year, as you said, by a wide margin. But if the US AI, as it were, bubble bursts, to put it that way, how do you rate the odds of that money rotating into, value stocks, defensive stocks, income stocks?
So let's look at the market caps so we can sort of quantify the dollars we're talking about here, that would sort of rotate out. Now, of course, anybody selling Nvidia, there's a buyer of that stock, so it's not necessarily cash moving into someplace else. But if there's a level of underperformance here, can there be outperformance there? Historically speaking, we sort of saw that in 2000 and 2001 when tech stocks imploded and value stocks did really well. 2002, everything hit the fan and the bear market infected everybody. But there was an opportunity for the market to sort of shift in other areas. I fear that we are so over allocated, economically speaking. I mentioned about half to more than half of growth this year is related to things that are touching the data center build out, and of course, being such a dominant piece of the stock market. I mean, when you look at the market caps of these hyperscalers, they're just so extraordinary relative to global market cap, relative to global GDP, that if they were to falter, the potential money that could be lost could literally be in the trillions. I mean, a $4 trillion market cap, all you needed for it to go down 25%, which is a normal correction, and you just wiped out $1 trillion worth of value. So I'm fearful that any pullback, any correction could be, sort of treacherous for other things. I think right now we've been okay because that dominance is waning. The S&P 500 relative to the equal weight is weakening. The Nasdaq 100 versus the S&P is weakening. The Nasdaq 100 versus the Russell 2000 is weakening. The Nasdaq 100 versus commodity stocks is weakening. So there are some signs that we're seeing some softness here, and but this is something that we really have to watch closely.
Yeah, yeah. I was just you talking about the massive market caps. Last time I looked, you know this, but last time I looked, Nvidia alone, the market cap of Nvidia was greater than the entire market of Canada, than the entire market of Great Britain. And they're really reasonably large markets. It's really quite astonishing.
Yeah,
Rich,
I mean the success of these companies have just been extraordinary. but I think it's important from an investor standpoint is understanding that technology generally, things change and they change fast. And just because a company has had an incredible run of success doesn't mean that going forward prospectively that will it will have that same level of success. Now, maybe like the build out of the internet, when for a while the winners were the fiber optic cable companies that actually produced the wiring, those that laid it down, like the Global Crossings and WorldComs and MCIs before WorldCom bought them, the telecom equipment makers like Nortel and Lucent, uh, the local exchanges, telecom companies, and then and the Cisco's, the backbone of the internet, which we know it was nicknamed. And then when that all collapsed, the benefits accrued to the users of the internet, Amazon, and so many others. And maybe, and not maybe, we will at some point do the same, where the infrastructure builders, they're having their day, that day will end, and then we'll see who the beneficiaries are of this technology. Because if they're not beneficiaries of it, then all that spend was to waste. Because if you're going to spend all that money, you better damn well monetize it.
Yeah.
So now we have to see, okay, how are they going to monetize it? And oh, one last thing I forgot to mention here with the whole AI thing. It's very important. And I mentioned DeepSeek, but what have we seen this year? China is a competitor like US technology has not seen before. They are rising fast up this value chain and they are creating their own models to the point where they don't need our models. Not only that, they are going to offer their models to the rest of the world too. So you're competing with a client in Canada. They can choose the US model, they can choose the Chinese model. Well, we'll see who's priced better, who's more capable. You look to Europe. We're competing against the Chinese on a level that we've never had before, not just to get into their market, but to compete against them with customers around the world. And that I think is a really big deal here too, when people try to quantify what is the return on all this spend that I'm getting, because maybe I won't be a global player like I once was in my prior product.
Right, right.
So Peter, I know we're very early on, but are you starting to see who those users are that may benefit? I mean, when I look at the interactions with AI right now, okay, and granted, it's very early on. You get the call prompts when you call an office, and you hear the fake typing in the background to make it sound like it's real. Where they're going through a system of questions and answers, and coming up with the next one that kind of leads you down a path, but not quite right, right? You have the annoying emails that seem to be, even ballooning further and further, where they're trying to generate leads and whatnot. And it's not even a real person. By the way they start off the email, that this is all AI generated. Where do you see the users coming from at this point, or do you yet?
Yeah, I mean, I'm beginning to see it. Whether it's someone in Hollywood that is using AI to create graphics, um, using a namesake sake to do. I mean, I'm hearing more and more cases. Some, but the question is
More
that
than
good
school
enough?
students writing essays, right?
Yeah, I mean, it's I had a friend tell me the other day that he was interviewing for a job. He had uh, one of the models sort of tape record the phone conversation, then uh, summarize the call in a note, and then he took the note, put it into OpenAI to spit out a thank you letter that was then sent to the interviewee. I'm sorry, the interviewer. Now, at the end of the day, Gen AI is just software.
Yeah.
It's just, but that's the history of technology, right? It's a new thing, increases the productivity and efficiency of our lives, as the phone did, as the PC did, as all iterations of software does. Now, this may take some leaps and bounds above previous AI. I mean, AI has been around for many many decades. We've been talking to automated people calling the cable company for many years now.
Yeah.
But there'll be some very positive use cases. But then there'll be things that will take time uh, and but monetizing it. OpenAI is selling, call it $20 a month for the average person. Gemini, Microsoft is Copilot, but then what about the open source that's giving it away for free? I mean, this is very much a commoditized product, and the Chinese and whoever builds the model, well, maybe OpenAI won't be able to get away with $20 a month. Maybe the competition is going to push that down to $10 a month at some point, or $5 a month at some point. I don't know. So how are they going to make the money? Is it going to be subscriptions? Or now they're trying to build out search. Now they're trying to build out shopping, where I can go to OpenAI, I can go to their search. It'll take me to where can I find the best shirts to buy, and then it'll show me the opportunity to buy from Macy's or Abercrombie and Fitch or the Gap or whatever. So there'll be ways of monetizing, and then they'll sell advertising. But there'll be a bunch of them doing that. But a lot of it remains to be seen. It's whether all the spend is gonna work out. But the thing about technology too is, and when you think about the data centers that they're building out, the biggest one that I've seen, and there are a few of them now that are being built, 4 million square feet. And the history of technology is the hardware gets smaller but gets much more powerful, right? I mean, this used to be a mainframe in the 1950s. So
Yards.
the 4 million square feet now, well, maybe in 3 years, you can improve the compute power and say, you know what, I only need half as many servers. Um, then what are you going to do with the extra 2 million square feet? So there's a lot of leaps of faith here, and maybe it works out. Hopefully, it does for these businesses. But these are the things that investors need to be thinking about. There are no layups here from now on going forward, I believe.
If I could, Adrian, just one more follow-up on AI. I want to hit this before we get away from it. So the other knock on something like AI, this type of technology, like say an assembly line way back when, is that when this comes in full force, people lose jobs. And the history of that is actually different. It actually creates more jobs. You still need the quality control. You need this, that. So where do you see this going with AI? Is this just half the workforce is gone or more, or are we going to find new places for them to sprout up and do something different within this new economy?
Well, I'm trying to be optimistic that there'll be certainly jobs that get disrupted. There's no question. Uh, Consultancy jobs are going to get disrupted. Legal jobs are going to get disrupted. Accounting jobs may get disrupted. It's going to happen. But I do want to believe, as you say, that there are going to be jobs created and that net, more people are going to be working than not, just as the history of technology has proven.
Yeah,
And I'm not going to think that this time will be different than the prior times. Yeah, again, short term, disruptive. So here's an example where it can go either way. Let's take the call center. There's no doubt that call centers or some AI is going to put some call center people out of business. But if there's one thing I think all of us have learned is when we call a help desk, if we want to troubleshoot something, we want to talk to a person.
mhm.
How many times have you found yourself on the phone
Representative.
saying, give me a representative, give me an agent, let me talk to a human being? So what Gen AI can do is it can help that call center person better answer your questions. Because if they don't know the answer off the top of their head, they're at a computer, they can type in your question, and AI can generate a helpful answer for you.
Gotcha.
So I think the desire of humans still wanting to talk to humans with important stuff,
Yep.
I think will keep a lot of people still working, and it's not going to be the doomsday situation that or scenarios that I hear people throw out there.
Good point.
I can't help it, I'm sorry, but I heard a story, I don't know where I heard it or read it, but a father looking at his son doing his homework, his questions, and his son was just using AI. He said, you can't do that, you can't do that. So they went into the teacher And he said, look, my son's just using AI, and I hope you're alert to that. And the teacher says something about, well, I didn't make up the questions. I mean, they're all done by AI. And the father sort of said something, well, this is outrageous. The teachers, AI is making the questions. My son's using AI to answer them. And the teacher said, well, don't worry, it'll be AI that marks them. So anyway, can I sort of focus a little bit on investing? So Peter, I've heard you talk many times where you talk about specific companies, and you obviously know a lot about those companies. So can you talk to us in a more general sense about your approach and style, and how do you're the chief asset strategist, I think, or you're in charge of
Yeah,
asset.
I'm a PM on two portfolios.
So how do you juggle asset allocation and your economic views with a plain bottom-up approach to investing?
So I manage two portfolios, and those two portfolios get integrated into a broader asset allocation. So my main focus is maximizing the value of these two portfolios, is really my biggest focus. And one is a global macro strategy. And the way that I invest is through a value lens. I am more attracted to things that are out of favor. I'm more inclined to read the 52-week low list to find ideas rather than the 52-week high list, where people like to buy high and hopefully sell higher. Now, you have to avoid being in a stock that is in a 52-week low list because it's going to zero, of course. But I try to find situations that are temporarily out of favor, my belief that they are, on the belief that at some point they will come in favor. So that's sort of the lens that I view investing. And
So,
that's
so
whether it's equities.
cheap and hated, but value as opposed to the best of the best at all
Correct.
times. Okay.
And I do that whether it's looking for stocks or interesting areas of fixed income or commodities or currencies that I find cheap. But sometimes some of them are intertwined where I like right now emerging market local currency bonds, where I believe that their currencies will appreciate against the dollar, in addition to liking their financial situation at the sovereign level. Or if I buy an international company domiciled in London, well, I have to have an opinion on the British pound. Or if it's domiciled in Switzerland, the Swiss franc, or in Germany, the euro, or in Japan, the yen. So they sort of mix together. Now, with this particular portfolio, I'm not necessarily trying to target a specific allocation in terms of the different assets. I really just try to find the ideas that I like the most. They will be more weighted, heavily weighted relative to other things. And then, I help our financial advisors mix this into a broader asset allocation, which is more sort of conventional and plain vanilla, but it works. So right now, with this particular portfolio, I am trying to avoid technology because I know our clients sort of have exposure there anyway in the other parts of their portfolio, believing that, as I laid out the case earlier, that their level of dominance in the next 5 to 10 years will wane dramatically relative to other asset classes and other parts of the market.
Now, obviously, if you're looking, as you say, you're looking at the 52 stocks with the 52-week lows. I know you don't mean just that, but you're looking at things that have lagged. Inevitably, if you're looking in those areas, you're going to find an awful lot of bottom-up opportunities in a relatively small number of markets or assets. So you're going to find more in, I'm going to say, Great Britain, the UK stock market, than you are in the US stock market. You're going to find more in the oil stocks, but in the silver stocks. How do you look at making sure you don't go too overweight, or do you care if you go overweight?
I don't care. I'm asset agnostic. I'm geographically agnostic. It's where I find the opportunities. And then, of course, once you find an interesting area like energy, very bullish on energy. I'm actually bullish on the UK market, believing it's dirt cheap. So I own BP and Shell,
Well, I
where
listen to you in your lane,
yeah,
so
so I can own two oil and gas companies that are priced well cheaper than Chevron and Exxon, partly because of where they're domiciled and partly because they've got into the renewable thing, but even though but they're pulling that back. I don't care where it is. If I find it inexpensive, if I find that there's a catalyst potentially, then I will invest in it. I have no sort of criteria going in. The criteria, in a sense, is set by sort of backing into it. So I like, okay, so let's take precious metals. I started at one point in 2018, but prior to that, I was long precious metals. So I sort of brought that idea with me. So us as a firm with clients, we've been long since 2018. Now, for a while, most of those years, up until call it 2022, you know, owning gold and silver wasn't something that you would, was a popular idea. Um, but I stuck with it because I believed in the underlying fundamentals. And then, of course, we've seen what has happened. Uh, of course, gold and silver are not on the 52-week low list anymore. They're on the 52-week high list, and seemingly every single day. So then it gets to the question, okay, well, how do you manage a position like that if you're someone who focuses on value? And that comes down to sizing an idea properly. Um, if a certain asset or holding reaches a price objective, you scale it down. We've been scaling down silver dramatically over the past week because when something goes up 5% a day every single day, I just think from a money management standpoint, it's a prudent thing to do.
oh,
Can
there's the hate mail. It started.
Yeah, can silver go to 100, 125, 150, 200? For sure. You inflation adjust silver for its 1980 peak, and that's 200 today. So we can go there. But when something goes vertical, I take some money off the table. But we're still long silver, more so gold, more so the miners, because I know a vertical chart when I see one, and that's just the way it is. What we've been doing is taking some of that money, believing that the industrial metal precious metal bull market, which we're clearly in, also in the industrial metals with copper and lead and zinc and aluminum and nickel and platinum and palladium, that it's going to broaden out to energy and ag. And so we've been taking some money off the table in precious metals, and we've been adding more to energy and ag via the fertilizer companies. Because being a value guy, I love buying energy and I love buying ag right now. Energy being 2.9% of the S&P 500. These fertilizer stocks trading around 52-week lows, yielding 3.5%. If I can buy a company that is free cash flow positive at the bottom of a cycle, or if they're not free cash flow positive, they have a healthy balance sheet that can buy them time, what a great setup. Because eventually the price of their underlying product will reverse higher. So you take a lot of the energy stocks that have actually been trading much better than the underlying commodity because these energy stocks, these companies, for the last couple of years have said we're focused on generating earnings and cash flow regardless of the environment we're in, and these stocks are trading at high single digit, low double digit free cash flow yields. So I'm like, they're generating that at $60 oil. Well, oil much below $60. OPEC, not only, well, they're stopping their increases in production quotas, they'll probably cut production. More than half of US shales doesn't make any money below 50. I'm like, I got this really interesting risk reward skew. That's why we like energy on top of a variety of, I have a laundry list of reasons why I like oil stocks and oil prices and natural gas. You take ag, same thing. Soybeans, wheat, corn, the three key row crops, relatively depressed prices. But if I can buy companies that are selling product into that industry, that are making money, paying a good yield at these depressed prices, well, I get paid to wait and I'm willing to wait because I know eventually, instead of corn being at $4 a bushel, it'll probably be 5 or 6 at some point. Instead of soybeans being at 10, 10 and a half dollars a bushel, it will go back to 15 plus, and wheat also at some point. So that's one way of looking at the commodity space. But commodities are not a buy and hold forever, right?
True.
Talking to two commodity guys, you can't, if you bought gold in 1980 and just closed your eyes and woke up 28 years later, you'd be like, really? This is what happened to my investment over the past 20 years? It's not like buying Procter and Gamble where you always have this growing pie of customers that you can sell into.
Yeah. You got to have your purpose. So I think I shocked Adrian when we were, and I hope he's coming back. I texted him to see if he's coming back. I'm not sure what happened. They might have had one of these Verizon issues coming out of Puerto Rico, but I'm sure he'll be back. But as we were getting ready to come on, I shocked him because I told him I sold some silver. Now I'm absolutely bullish on silver. I was bullish before the Chinese put in their export, restrictions January 1st. And that just even makes the target higher. But I look at gold and silver differently. And I think the folks that follow us know that. I look at gold as wealth insurance. I have a small allocation. I buy it, I hold it. I never touch it at all. Whether I bought it in 1980 or 1990 or 2000, I don't touch it unless I have an emergency. So that's what its function is for, just to store purchasing power, liquid form for crisis. Silver's profit motive for me. So yeah, although I think silver's going much higher, I sold some here. I mean, my God, I took out more than I put in. I still have well more than that, left running. Why wouldn't you do that for a for-profit motive? So I like buying well. I like taking profits along the way. I have no problem with that.
Yeah, I agree, and for both the sell reason, and I still think silver goes higher. And I've told people internally, I promise you, I'll make a bad sale. I promise you, I will
You make
not
your
pick
money
the
buying
top.
well, though.
We bought well, but I promise you, I will not pick the top. But still have. But it's still always good, yes, because silver is I look at it different than gold as well. And we're still in the money making business
Yep.
as portfolio managers. You still always have to test your thesis. You still have to understand that commodities generally are cyclical and they're not necessarily buy and holds forever. Now, I do like buy and holds,
Yep.
and in my portfolio, there are buy and holds. Um, and just to get to the point of the way that I manage money is somewhat eclectic in that I can own a gold stock, I can own a Brazilian bond, and I can own Pepsi. Um, there's no theme that goes through that. It's just where do I find opportunity? Where do I find interesting opportunities, regardless of asset class and regardless of where it's located.
Gotcha. Now, I will tell you that our audience does skew toward commodities and precious metals specifically. So we're already starting to get some questions. I know we're going to get there. One of
So
them,
wait, I would bore them by saying I'm a big bull on Kimberly Clark.
no, you're not going to bore them. I think it's good information to share.
Okay.
But by all means, share your insights. That's why you're here. And not everybody is an automaton, speaking from the AI script here. So, um,
Yeah.
one of the questions came up: is there a commodity that is still hated, but might be a good investment right now? I can think of a couple off the top of my head, but
I think a barrel of oil at $60 is one of the cheapest assets in the world.
yeah,
20 years ago, oil was $60 a barrel. Um, now I know I'm just picking a moment in time here, but you inflation adjust 60 20 years ago for today, and oil would be 100. And yes, the drilling of oil has gotten much more efficient and much more from a cost perspective. But I think it's dirt cheap at $60. And again, I have a laundry list of reasons why. So that's one. Getting back to ag, um, corn at $4, soybeans at around 10, wheat at around $5 or $6 a bushel, I think are all very cheap. So those would be ones that I would throw out there that I find pretty attractive.
Staying on the energy theme, what do you think about uranium? That gets kicked around a lot as
Yeah,
cheap.
so we've been long uranium for years now as well. I think the easy money has been made in uranium. I think we all know about the demand side drivers, not just feeding data center demand for electricity, but just the whole world understanding that you can't beat nuclear in terms of baseload power, reliability, and it being clean. So we're still bullish on uranium, but when Cameco got to 100 from 10, I thought it was prudent to take some money off the table. So when it comes to it from here, if it rallies further, we'll probably also take some money off the table, and keeping a close eye on the supply side that's coming on stream over the next 5 years. Because right now demand's certainly outpacing supply. It's still a compelling story, and the price of uranium can double from here, and it won't change one iota the decisions on the part of electric utilities to buy it because it's a very small piece of their overall cost pie.
Do you think we can ever get past, the horrors of the past, the Chernobyl and the 3 Mile Island, and people can embrace it for its capabilities, or do you think we'll ever get over that stigma?
No, I think we will. I think because, history shows that it's pretty safe. And as you have a whole new generation of people that don't even know what Island is,
I
and
grew
they
up in
don't.
Jersey, so I'm very familiar.
Yeah,
All
and
over the
and
news.
Chernobyl they know from a documentary on TV, and Fukushima was because of a tsunami, not because of the plant itself.
Yep.
So I think yeah, I think the stigma is being put behind us, particularly when you have countries that are turning them back on, some that had plans to um, retire them, like Germany did idiotically, that had said, you know what, let's not do that. Even California with Diablo Canyon, like I think everyone is now appreciating the capabilities, and with the small reactors obviously being the new thing, I think that will be fully accepted in a safe, reliable way.
So I appreciate that. I know you had talked a bit about not just gold and silver, but other commodities. One of the attendees raised the question: Are we in a commodity super cycle, and how will it affect other companies like Nestle and so forth? Do you think we are in a commodity super cycle right now?
So I never like to define it that way because
Yeah,
whenever I hear super cycle, I get nervous
it
that
sounds like
maybe
bubble.
we're well into it.
Yep.
Um, I'll call it just the bull market in industrial metals and precious metals. To
Gotcha.
me, that's apparent here. And like I said, I do think it spreads to energy and ag, but it hasn't yet. I'm waiting, but I think it will. So super cycle, people can use that. I I don't want that to take me away from still doing homework every day and making sure that the fundamentals still support higher prices.
Gotcha. And then just to kind of shift to gold is my question. I have a theory, if you will. I've been in the industry 30 years. So when I was in the 70s, I was alive, I was coherent, I was, taking it all in, but I was oblivious to the bull market, right? I was getting ready to get out of high school and go to college. And, I didn't really pay attention, although I've studied it afterward. The last bull market, I was trading through it. This one, I'm trading through it. So I'm a little more familiar with what's going on right now. The bottom line is people are saying gold and silver are very high right now. Okay. And you know, I can't argue with that. But what is your view on gold? Because my theory is, we still have room to go. Again, it's a wealth insurance for me, so I'm not buying it for profit. But I do have a theory that this bull market could be extended because I think the central banks gave it about a 3.5 year head start. That retail investors, at least in the West, weren't paying attention to gold, no matter what we said, no matter what arguments we made, no matter what price appreciation we could show them. It was all driven really by central banks, and then investors got in it. Do you think it has a longer shelf life potentially because of the head start from central banks, who, by the way, don't seem to be slowing down?
I do think so. I mean, the way that I try to sort of figure out the possibilities with gold on the upside is looking at, the value of gold relative to the size of central bank balance sheets and how they've grown over the years.
Yeah.
See it relative to, U.S. money supply, see it relative to as a percentage of global financial assets compared to previous timeframes. In order to try to provide context, I guess, because obviously you're not discounting a stream of cash flows as you would in valuing a business. So we're really talking a lot of art, not science.
Yeah.
And I'm sure I'll sell my gold too early also, the goal that we have for client portfolios. Um, but I do think that, no, it's interesting. So when gold was, call it 1500-ish, obviously it hit 1900 in 2011 and then went through its own bear market.
Got that back to 1,050 in
Yeah, so
two thousand thirteen.
call it 1500. Like back then I
Yep.
was like, yeah, if it goes to 3000, maybe I'll probably sell. But you know what? Things change in terms of the fundamental drivers. I was not envisioning back when gold was 1500 pre-2022 that Russia would invade Ukraine and then we would confiscate half their reserves. I didn't envision that China said after 2018, you know what? I think we were a bit over our skis here in terms of our dependence on the U.S. Sourcing us product and
Yep.
technologies, and we need to start doing stuff on our own. And
Mhm.
also, we probably own too many treasuries too. Um, and then, of course, as you said, the Western investor being sort of apathetic up until last year. Not only were they apathetic, they were outright sellers of gold because
There's
they
no
said, "Hey,
question.
why would I own it when I can get a 4 to 5% interest rate on T-bills?" So yeah, now they've come around and understand the importance of it. But so I think it's important when you're looking at the market is to constantly look at the fundamental factors and are they still intact? Because yes, central bank buying has been a factor, but when I look at 2025 too, the US starting a trade war with the rest of the world, agree with it or not, it still was a trade war that pissed off a lot of people around the world. That was not something. Now, I knew Trump was going to do the tariff thing coming into this year, but I thought that he would learn lessons from 2018 and not have sort of a scattershot approach rather than a more focused, tailored approach on specific, technologies and that we want to protect here.
Gotcha.
And to this day, the Canadian travel to the US is down 25%. Canadians are not buying Kentucky bourbon. Um, European companies are trying to source things from other countries rather than the US. Well, when all this stuff starts to happen in not in currencies that are not dollars, um, it reduces the dollar as a transaction currency, and gold sort of filters in because gold then becomes a more important reserve asset rather than dollars.
Yep.
And it becomes also a settlement asset too, where Russia sells oil to China in renminbi. And gold is sort of whatever's left over after Russia takes that renminbi and buys stuff from China. There could be a settlement in gold. So things happen that you don't necessarily imagine today that
Yep.
could influence that price. And we know we're in a more multipolar world right now, for better or for worse. And that to me was sort of a new incremental bull case to gold that I wasn't foreseeing coming into last year. That I think sort of breathes new life in terms of the potential upside for it.
Gotcha. Well, I think this is a good point. First, I just want to make an announcement. So I texted Adrian, cell service or something is down there. The internet is down. I finally got a text from him saying or an email from him saying the internet is down. I don't know how he got it out. I don't know that we're going to see him again tonight. So this is the joys of living in Puerto Rico, I guess, at this point. But we're going to continue on. We only got about a half hour left. We're going to take a few more questions. But before we go further, I know Adrian wanted to take the time while we still had everybody engaged because you've already shared some incredible insights. How can people find you and give us a little idea about what you could do for people that are interested in your services?
Well, on the wealth management side, people can go to our website, 1.BFG, Boy Frank George, or BleakleyFinancialGroup.com, and learn more about our services. We've been around for about 40 years now and manage about $15 billion. And I also write every day on Substack. It's called the Book Report. And I write on markets and the economy and anything that's relevant to one's investments. And people can trial it. And if they like it, they can subscribe.
Fantastic. And just a little bit about the services you offer. So you mentioned you manage two portfolios for your firm, but you're one piece of the firm's pie, right?
Right. We have about probably 50 to 60 different financial advisors that do, very conventional wealth management services, everything from not just asset management, but estate planning and um, children's education, 520, the whole
Do
financial
it all.
planning thing.
Yeah.
Exactly. Soup to nuts.
Fantastic. And for those frantically trying to write stuff down, we'll include this. We're going to send out a recap email tomorrow with the link to the entire webinar. And in that email, we'll have the way to contact you. So you don't go crazy trying to get it down now. So back to the questions. So somebody said gold and silver are high. That theme's come up. What are your views for gold and silver this year? I know that's short term.
Yeah. So silver, when it goes parabolic, which it's in
I think
a
it's safe to
para
say. Yeah.
it's in a parabola. What that does is it takes pulls forward a lot of future returns. So 12 months from now, I wouldn't be surprised if silver wasn't any higher. Will eventually silver go to 125, 150, 200? Yeah, I think so. But the rapidity of this move is pulling forward a lot of future price appreciation.
Gotcha.
So it's really hard to call when you enter this technical phase to say where we're going to be 12 months from now. I know a pretty nasty correction is coming our way because that's just what happens when something goes straight up.
So nothing goes up forever.
Exactly.
All right.
Things usually come straight down. The real test will be after it pulls back,
What does it do next?
where does it settle out at? And it'll take some time to digest and consolidate. And is that the next base forming for another run? Because when something goes straight up, the analogy is a runner. You can't sprint 26 miles. Well, I guess you can if you're doing, the 4 minute mile. But take the average person. When you sprint too fast, you need to take a rest.
Hmm.
You need to recharge. And silver's entered that mode. Gold, and also keep in mind too, silver right now is trading more like an industrial metal,
Mhm.
not like a monetary metal.
I agree.
It played catch up to gold as a monetary, but when copper started to go, silver started to go,
Yeah.
which means that there's now some economic sensitivity that it is subject to for whatever reason, which makes it now different than gold. Where if there is any economic issues, gold can actually maybe outperform silver this year because of the dramatic gains that silver has pulled forward, I believe, for a period of time.
Yeah, I can't dispute that. So the next question, I guess, kind of follows. What about the supply demand story for silver? And then what's the exit strategy for silver and gold? And I have a little bit of thoughts there as well. But so the supply demand story for silver, what's driving this?
So I think we're in our fifth year, or now we're about to enter our sixth year of deficits.
Yep.
But it's important to look at what has caused the extra demand relative to supply. Interestingly enough, while silver is going into a lot of sort of new tech applications. Overall industrial demand for silver fell in 2025 because global manufacturing was in a recession.
Yep.
The reason why demand exceeded supply in 2025 was because of investment demand, ETF demand. That's why the demand for gold exceeded supply, not because of the industrial side, not the jewelry demand fell.
Not solar panels, not
Not
AI build out of
right.
data
It was
center.
the investment demand. So
Yeah.
people have to keep that in mind that yes, silver is going into a lot of interesting and industrial uses, and more of it's getting eaten up. But understand where the main demand driver came from.
Investors and ETFs.
You
Got
know,
it.
on the gold side, and also we also have to know the benefit to gold is because it's a byproduct rather than there aren't many silver mines out there,
Yeah.
pure silver mines.
Yeah.
Obviously it's tougher to get out of the ground. Gold,
Inelastic. Yeah.
yeah, I think gold, people know that, you know, what's global supply usually around 2%, 1.5 to 2% has been, you know, pretty standard rule of thumb statistic that we all know about.
It's probably where they came up with this magical inflation number, just to kind of
Yeah,
keep the
2%. And
gold.
you know what's interesting? Bitcoin too, there's its supply goes up about 2% a year.
Yeah.
Um, Having no opinion on Bitcoin, but I just threw that out there.
Good.
So now the interesting thing with gold is the buyers of gold over the last 4 years are buy and holders of gold. Looks like Adrian's trying to get back in.
Hey, there he is.
So I think that is interesting that um, while we all know that all the gold that's been mined above ground, right now a lot of that is in vaults that will stay in those vaults for a very long time. So on the supply side, outside of that 2% production growth, um, demand, and interesting with central banks are price agnostic.
Yes.
They want the gold. They don't care whether they pay 3,000, 4,000, 5,000, $10,000 an ounce. They want the gold in their own vaults that no foreigner can touch.
Yep. And I don't think investors look at it the same way. So to be honest with you, I mean, I do. But
Right. No, I mean, I think you have a class of investors that are buying it because it's going up,
yeah.
and they will sell it when they sell it.
Yep.
Then you have those that buy it because this is what they want to own forever. Then you have those that buy physical and they'll be giving it to their kids and grandkids. You know, everyone has, I guess, their own motive
Yep.
when they approach it.
So and there's one other question that kind of leads into that is the exit strategy. So and that kind of dictates how you get out of an investment, whether it be gold or silver or what have you. Um, your thoughts on that? I think
Well,
you've
price
already
a
covered
lot.
it, but just
Yeah, I mean, a lot of it's price that will dictate. Like I said, you know, silver going from 50 to 90 in seemingly a month or two. That's enough for me to sell a bunch of it. Maybe I buy some back. I still want to hold some. Gold. Hey, if gold goes north of 5,000, yeah, I'm going to probably sell some. Gold goes to 10,000, I'm going to sell a lot more. Um, but again, from a portfolio management standpoint.
yeah,
That's, I think, the right thing to do. Putting aside, you know, those that, you know, some of us will, there'll be a portion of gold that we hold forever. That's just like you said. And I will as well. But for clients in a portfolio management perspective, risk management perspective, yeah, there'll be a point where I won't own any. And then maybe we go through another 10 to 20 year period where gold just chops around, consolidates the previous bull market, and then I'll get back in and get ready for the next bull market.
yeah, and I think it's important that it matters why you're owning it, right? So
Right.
as
Always
I said, I'm
test your
owning it.
thesis.
Yeah, I'm owning it for wealth insurance. I'm owning it for a store of value and a crisis hedge. If I don't have a crisis, I'm not getting rid of it. It's doing its job. I don't. When it went to 1900, dropped to 1050, I could still get the goods and services I needed out of that ounce of gold as I did at both prices. And that's what I think a lot of people have trouble coming to grips with because the dollar's fluctuating, not that ounce of gold in most cases. So I'm good holding that forever. I really don't have an exit strategy. I'm not a collector, but I hold my insurance policy intact. Silver's a whole nother story. Platinum, palladium for me. I'm in and out of those. I'm trying to buy well and I'm trying to take profits all along the way. And when the bull market's over, I may not have any. I'm with you there
Yeah. Yeah,
because
we're long platinum too, and I'm trying to figure out how to manage that position.
yeah, when their usefulness ceases, then it's gone as far as I'm concerned. But
Right.
right now, I still see plenty of potential there, so I'm
Yeah,
playing the
agreed.
whole market. So hope that
So
answers.
Peter, Rich, sorry
Yes,
about
yes,
that.
there he is.
No, my internet went, but also my phone and my
Oh
I
God,
couldn't text you.
I got your email, and I told everybody what was going on. I said I didn't know if
Yeah.
we'd see him again, but I'm glad we did. So
And my Starlink isn't working for some reason. So
uh,
everything went. Everything. Sorry about that.
that's okay. You're back.
Um, yeah. So uh, you've talked about gold and silver quite a bit, I assume.
Yeah, I
Have
think
have you talked about oil? Because you said that was a high conviction.
Yeah, we touched upon it.
Okay.
That's right now my favorite commodity from a value perspective. I argued that a barrel of oil at $60 is probably one of the cheapest assets in the world. And I have a variety of reasons why I'm bullish on it. And if you can buy companies that are producing free cash flow with free cash flow yields in the high single digits, low double digits with oil at $60 and natural gas at three-ish, imagine the profits they're going to make when when those prices are higher, which inevitably will be. So I'm very
There was
bullish.
not there was an article in the FT. I don't know if you saw it. I saw it on Jesse Felder, actually. I didn't see the article. But this chap Peter Armstrong did a table of S&P sectors, subsectors that were priced above and below their 10-year average price earnings. And there were only two sectors he had that were priced today below their 10-year average price earnings. One was oil and one was real estate. Real estate by a small amount and oil stocks by a huge amount. So no question that was the cheapest, the cheapest sector around today.
And it's 2.9% of the S&P 500. And there was a time when I think it made up 30% of the S&P 500. So going back decades, this is like almost an historic low, just off recent lows in terms of its allocation. So
Yeah.
um, its market cap is tiny relative to the rest of the market.
I'm glad we went back to oil. So one of the questions here is, according to Doomberg, we are an energy glut. Is he wrong?
Yeah, so I actually subscribe to Doomberg, and I on my reading list tonight is to read his recent piece. And I agree with Doomberg in the sense that we're not running out of oil. Technology will always find more. But that's been the case for a long time when you still had booms in terms of the price, and then you had busts. So you do get these pockets where there are supply demand imbalances, and it leads to price increases, it leads to price declines. I just feel from a risk reward standpoint at $60 oil, we have sort of a floor because if you get much closer to 50, people are going to stop drilling. And if people stop drilling, there's going to be less supply with still pretty steady demand of 1 million to 1.5 million barrels a day. And that's going to lead to higher prices. And then we'll get to higher prices. And then the drilling will come back. And then we'll get lower prices. That's what commodities are. So yeah, Doomberg's right in terms of all the supply, but according to him, we'll never have a bull market again in energy, which I think he's wrong. We will have bull markets again in energy, which will be followed by a bear market, which will be followed by a bull market. That's how it goes. So that's where. So he could be right, big picture, but I just think that in terms of timing, we're more inclined to be following $60 oil with a bull market than one with a bear market. Because we're already in a bear market. That's why
Yeah.
it wasn't 60.
Yeah.
So Adrian, I don't know if there's anything you wanted to ask because you don't
No,
really know what we covered, but we've covered everything along the ways. We didn't get to specific stocks. We did have Peter, let people know what he does and how to reach him. And then Karen, your assistant, has actually put it in the questions, all the links. So thank you, Karen, for doing that.
I would add one of the other things that I am heavily focused on this year and was last year too, that I want to bring up, and that is long-term interest rates around the world. for developed countries. I think that debts and deficits now matter. You see that in Japan, where JGB yields are going up seemingly every single day, both in response to higher inflation relative to their overnight rate, but also recent concerns about another fiscal spending party with the new prime minister. The ECB has cut interest rates by 200 basis points since the summer of 2024, and German and French bond yields are up dramatically from where they were prior to those rate cuts. The Fed has cut 175 basis points beginning in September 2024. In June of 2024, before it started to price in those cuts, the 10-year yield was about 410, 420 versus today, 410, 420. So I think we remain in a long duration sovereign bond developed country bear market. Oh, and look at the UK. Gilt yields, while they're off their highs, both in 10s and 30s, they're still up well above where they were before the Bank of England was cutting interest rates. So central banks, at least in Europe and the US, and Canada, Australia, they only have control over the short end. The long end is going its own way. And what's happening in Japan, I think, is a really big deal. The Bank of Japan was the architect of modern day monetary policy. They're the ones who really first experimented with zero rates and QE that Bernanke thought was such a brilliant idea. He wanted to do it here. And the Europeans thought it was such a brilliant idea. They said, hey, we'll take it one step further and concocted negative interest rates. Rising JGB yields matter for the whole world because of the amount of foreign money, or say the amount of money that the Japanese have in foreign assets. And Japan being the largest foreign holder of US treasuries, that if we do reach a point where the JGB market is more attractive than the US Treasury market, well, they will speak with their wallets and repatriate a lot of that money home. And those are the things that I'm watching for because every day that JGB yields go up, I say to myself, we are one day closer to having an accident in Europe and the US in terms of long-term interest rates. And as much as Scott Bessent wants to tame long-term interest rates in the US, I think that's going to be a really interesting fight with the Japanese at some point.
So, Peter, given what you just said, given the reduced interest in U.S. Treasuries from particularly foreign official sources, but also given given tariffs, given the Fed Trump, the Powell Trump spat, shouldn't interest rates actually be higher? And that leads me to the question, where are the bond vigilantes?
Okay, so let's take Monday, this past Monday, when we wake up, we saw the Sunday tweets from Trump or what am I saying? We saw the potential indictment, criminal investigation, and we saw gold up $100, the dollar down, the 10-year yield up, and the S&P futures down. So then, okay, we look at that initial reaction. And then by today's close, the S&Ps are kind of flattish, but a little shaky this week. The 10-year yield's actually lower. The dollar is sort of mixed, but gold is obviously higher. So I think that sometimes foreign flows don't necessarily express themselves in where we would think. Because one of the things that I think was a big characteristic of 2025 was foreign investors said, okay, US, we still want to invest in your market because it's an attractive place to invest. However, we are no longer diving in unhedged. Because after the first half of last year being the worst for the dollar since the early 1970s, we are now hedging. So foreign official holders of US Treasuries have been selling. They sold last year, they're going to be selling this year most likely. But other private investors have bought, and they're hedging their dollar exposure. So that's why I don't think it's necessarily being expressed yet in US Treasuries, and it's more so being expressed in gold. Now, when you talk about the US dollar, you have one fiat currency versus another, but the US dollar cannot get out of its own way in terms of the upside. Yes, it stopped going down. You look at the euro yen heavy dollar index, and the dollar's been strong recently against some of the Asian currencies, but quietly, the Chinese yuan is at a 2.5 year high.
Yeah.
That to me is potentially a really big deal because the Chinese yuan doesn't go to a 2.5 year high against the dollar on pure coincidence. It goes there because the Chinese authorities want it to go there. Because maybe a $1.2 trillion trade surplus in 2025 finally woke up the Chinese to say, you know what? Maybe we need a little bit of rebalancing that we can sort of implement ourselves. We know we need to increase consumer spending. We know we need to rely less on exports. So let's tolerate some yuan appreciation here. I think if this continues, it actually creates cover for the yen to eventually rally, which I think the Bank of Japan is finally getting the message that in order to stem the yen weakness, they need to continue to raise interest rates. And Governor Ueda said that last night. So that yesterday, last night being Eastern time. And I think that that can help all these Asian currencies. Then you take Latin America, have the potential for a bunch of Latin American currencies to rally on the heels of what's going on in Venezuela. If that country can have a democratically elected, legitimately democratic elected president, and they can go away from socialism. We see what's happening in Argentina. Chile just elected a business-friendly center-right politician. And we had the big election in Brazil in October. That if Lula wins, I'm sorry, if Lula loses, things are going to re-rate in Brazil, including their currency.
He's
So
ahead right now, though.
he is because there's still this anti-Trump and Bolsonaro thing, particularly with the father saying, "I want my son to run."
Yeah.
That's a problem. I agree. But if he doesn't run and the finance minister does instead, or the ex-finance minister, then there's potential. So I think right now, can it be reflected in U.S. Treasuries? Yes, at some point. But I think right now, because of the ability to hedge the dollar exposure, not yet. But we will reach a point with yields being attractive overseas relative to the U.S. where their yields, their bonds will be more attractive to the U.S. And that's when you'll have a real issue with U.S. Treasuries.
Fantastic. Well, I told you when we were getting ready to flip the switch on tonight, Peter, that this was going to go fast, and it has. We're down to what, 6-7 minutes? Do that whole thing 6-7. That's about what we got left. I'd like to take time. There's only a handful of questions we didn't get to. I apologize to those who sent them, but I think we did a good job. Can we kind of go around the horn? We'll start with you, Peter. The one point that, if anybody's going to remember from tonight, what is the one thing you want to leave them with, and then reiterate how they can get a hold of you?
The AI tech trade is not forever in its current form. AI will be forever. Software gains will be forever. But the current dominance of the Gen AI data center build out is not forever. And if that changes, which I think we're in the midst of it changing, it's going to have broader implications. So those investors that are very heavily allocated to that, I think they need to rethink those allocations and size it properly.
Gotcha. And how do people get a hold of you? Although it will be in the recap email tomorrow. One more time.
Yeah, so onepointbfg.com, our website, and go on Substack, type in my name, and you can find the book report.
Fantastic. Adrian?
Yeah, in the introduction, I forgot to mention the book report. I really apologize.
I love that name, by the
No
way.
problem.
Yeah, but you've discussed that, presumably. It's
Yes.
very, very inexpensive, and it's a wealth of information.
Thank you.
Well, I was going to mention AI, so I'll mention something else. And that is the importance of taking profits, the importance of right sizing. You know, however bullish, silver's a good example, as you well explained, but however bullish one might be on silver for the next 1, 2, 3, 4 years, and there's always really good reasons. Anytime a thing goes up exponentially, there's always good reasons to think it's going to continue, always, or it wouldn't have gone up, right? The discipline of right sizing, I'll call it right sizing, is tantamount. And I think all three of us, if I may, have sort of trimmed our silver holdings to one degree.
I told him how I shocked you before we got on the air, so
You
I
didn't
shared
shock
that.
me. I was joking. I was joking, but we've all trimmed our silver to one degree or another in the last couple of weeks, and I just think it's critical. And missing out on further gains and missing out on opportunities is not as important as protecting what you've made. I don't know who it was. It wasn't you, was it, Peter? But someone just said, you know, if you miss an opportunity, there'll always be another one. Opportunities are easier to make up than our losses.
Correct.
It's a good point. Yeah. Fantastic. And how can people get a hold of you, Adrian?
Well, it's what is it? AdrianDayAssetManagement.com.
Fantastic. And then we're all along the same lines. You know, I'm incredibly bullish on precious metals. I do think we're still got plenty of room to go. But I'm cautioning people just to remember why you invested in whatever you invested in, and make sure you treat that investment as you intended, right? So if you have a small allocation to gold and it's supposed to do a certain job, let it do it. If you have a small allocation to silver and now it's a massive allocation, like we all said, take steps to put it back in its place. You know, you never go broke taking a profit. It's not a 4-letter word, it's 6. Go ahead and do it. It doesn't hurt. It actually feels pretty damn good when you do it. So, and you can reach us toll free, 800-831-0007. The phones are heating up. That's the one other thing I'll say, Adrian. You know, we talked when we first got on, and I've been saying for a few years now that this is the weirdest bull market on earth, and I'm not the only one saying it. Prices going up exponentially, and yet nobody's buying. Where the hell is this coming from? Obviously, it was central banks, but that has changed. I'm telling you right now, this is what a bull market feels like. I've seen them before. We are buying and selling daily and intensively in this bull market right now. So it feels good. It feels like it ought to. So 800-831-0007, assetstrategies.com. Info ASI at assetstrategies.com. And thank you all for taking the time. Peter, wonderful to meet you here. I look forward to seeing you in New Orleans again this year. Adrian, as always, you're amazing. And y'all, thank you for joining us. We look forward to our next one. We'll be announcing what that is as soon as we figure out what it is and when it is. So have a wonderful evening, and thanks for joining us.
And thank you so much, Peter, for coming.
Yeah, thanks for inviting me, and it was a pleasure chatting with you guys.
Yeah, ditto. All right.